Today we're going to talk about refinancing your mortgage. When we talk about reasons for refinancing, there's probably two main reasons. One of them would be maybe to consolidate debts. So you may have Visas, MasterCards that you're making larger payments on. So you refinance a mortgage because the payments are a lot less. So that's one reason. Second reason is you may be in a mortgage where the rate is higher and rates have become so low that it makes sense to refinance your mortgage. Having said that, sometimes the combination of the two is even a bigger reason. You can consolidate your debts, pay out your existing first mortgage, and get a new mortgage at a lower interest rate. When we talk about the rules for refinancing your mortgage, refinancing, if you're doing an insured mortgage, the maximum right now that insurance companies will go along with is 80% lending. So it doesn't mean that they're still not insuring mortgages, but they will insure a maximum of 80% loan to value. So what that means really is that it is quite difficult to get a very high loan to value mortgage to do a refinancing. So if you were looking for the 90% of the value of your home in a mortgage, it's become very difficult, and quite often you need to go to some very expensive private sources, and at that point it really doesn't become practical. So for refinancing, most of the insured lenders, and in terms of the banks, they're basically held to 80% loan to value in terms of what they can refinance for a client. 80% of your home's value. Yes, there are costs to refinance your mortgage. Most people have an existing first mortgage on their house, and they're closed mortgages with maybe a major bank or an insurance or trust company. So when we talk about a closed mortgage, if you wanted to pay that off, there's a penalty, and most of the time the penalty is a 3 months bonus. So that's 3 months interest is the penalty. It can be more than that, so it's important that we find out, what is the payment to pay out that mortgage. That would be part of doing, taking a look at the value of refinancing. They do what's called an IRD, an interest rate differential. So just to give an analogy, if you're sitting with a mortgage that's at 7% and the rates now are at 4%, when you go to pay that off, that can be expensive because the lender is currently getting 7% and says, well, when I get paid out, I can only put it out at 3 or 4. So it can be expensive sometimes, but so you pay a minimum of 3 months penalty to pay out a mortgage. Other costs would be things like legal fees, appraisals, things like that, but the major cost is seeing if there's a penalty for an early payout of your mortgage. Even if you have bad credit, it is still possible to refinance. Providing that you have equity in the property, again, whether it's private or A type or B type, any type of institutional lender, for a refinance, it usually stops at around 80. Some private lenders maybe would go to 85. So if you have bad credit, but you still have equity in your home, the answer is for people with bad credit, so the rate is higher. Somebody with bad credit wouldn't be able to go into an A-type lender, let's say a bank, and get the lowest rate available. If you have bad credit, that wouldn't be available for somebody with bad credit. So yes, you can refinance, but the rate would be higher. There are some companies that we call them B lenders that specifically lend to people with maybe bruised credit or some different challenges with their credit, and their rates are higher. And if they won't do it, then we turn to private lenders. But for all types of lending, equity is the key. Well, to determine whether, what is the best option when you're refinancing, we look at all the different options. And as I mentioned, we start with what's the cost to refinance an existing mortgage, what do they want as a payout or a penalty. We look at who holds the first mortgage. For instance, if you're somebody that does have bruised credit, and if we went to an A lender and they wouldn't approve you, and you do have an existing mortgage with an A lender, it may not make sense, to pay that lender out and go out to a private lender or a B lender and pay a higher rate. One thing might be that, yes, you do have bruised credit right now, or you had some kind of a problem. Maybe you went through a separation or something, but it's going to be better. So what you don't want to do is to pay out an A lender to go to a B lender if you don't have to, because when that mortgage comes up for renewal, they're still an A lender, and then they're going to offer you, very competitive rates. But if you pay them out and your credit doesn't get any better, it's very difficult to get back with an A lender. So we look at all the options. Should we maybe leave that first and maybe give you a loan or a second mortgage to pay out? Let's say you're consolidating. Sometimes a second mortgage is a better answer. So in summary, we'll look at all the options, decide which is the best way to go. And the truth is, sometimes maybe refinancing isn't the option at all. If you need more information, give me a call or send me an email. Your call is important to me and I will call you back. I look forward to speaking with you. Take care.